Hi, my name is Paul and welcome to month number 9 of my $100 per month Canadian stock portfolio series. Unfortunately, I did come down with COVID just a couple of days ago, so please bear with me if my voice sounds a little bit off at times throughout the video. Anyway, this time I'll be analyzing MTY's acquisition of BBQ Holdings Group, and I'll also be going through Knight Therapeutics' second quarter earnings report, giving my opinion on the results. Additionally, I'll be talking about how my portfolio has performed against the benchmarks, and as always, I'll be showing you exactly how I'm going to be investing this month's $100 of contribution as well as the dividends earned over the previous month. But first, if you're someone that's new to the series and you're interested in hearing about the goals and rules that I have for investing within the portfolio, then you might want to check out the document linked in the description of this video where I outline all of that in detail. That said, I'm now going to quickly give a brief recap of the companies that I hold within the portfolio. The largest holding is the Morguard North American Residential REIT, ticker symbol MRG on the Toronto Stock Exchange. There are 2 other Morguards on the TSX, so you should make sure that you're looking at the right one with the ticker symbol MRG. Now, Morguard owns and rents out apartment units in cities and large suburbs throughout the United States and Canada. The reason that I've been investing in Morguard is because I believe it's trading at a heavy discount to the net value of its properties, and it offers a better value than its peers. Also, because MRG's properties are strategically located in cities and large suburbs that are expected to continue seeing population growth over the coming decades, I believe that this security will provide me with a good return on my capital for years to come, and it's my strongest conviction in the market. The second holding is MTY Food Group, with the ticker symbol MTY, and it also trades on the TSX. MTY operates and franchises fast food, casual dining, and other specialty restaurants, mostly within the US and Canada. More recently, MTY has begun selling and distributing retail food products centered around their successful franchise brands. One of the most important factors contributing to my investment into MTY is the strong history of success in acquisitions and high level of insider ownership. Also, based on the management's capital allocation decisions, MTY feels like a company that's being run with its owner's best interests in mind. In addition to that, MTY has historically provided very good shareholder returns and is currently trading at a much better valuation than its slower growing competitors. The third and final holding in the portfolio is Knight Therapeutics, which trades under the ticker GUD on the Toronto Stock Exchange. Knight is a specialized pharmaceutical company that predominantly operates in Latin America through the licensing, marketing, and distribution of pharmaceutical drugs. What originally drew me to Knight was the past success of the management team, who have built a business around acquiring mature and underpromoted pharmaceutical products that have the ability to return capital with minimal added expenses. Currently, Knight trades at a considerable discount to book value, and I believe that the intangible assets from the recent acquisitions will return tangible, growing capital to the business over time. On top of that, Knight loans money to biopharmaceutical companies in return for exclusive rights to purchase, market, and distribute successful products developed by the borrowers, which is a low-risk, high-reward model that I believe is being overlooked by the market. As of now, that's everything that I currently hold in my Wealthsimple portfolio. But if you happen to be interested in a more detailed breakdown of these investments, then I recommend going back and watching the series from the beginning. In the first couple of episodes, I cover my reasoning behind these investments in depth, and I continue to build on that throughout the series. If you go to the description box below this video, there will be a link to the portfolio series playlist, which has every video in the series ordered from first to last for your convenience. With that, let's get into the meat of the video by covering the news and financial results that came out over the last month. First is Morguard, who had nothing too noteworthy to cover this time around, aside from announcing the specifics regarding their downtown Chicago property acquisition, which was revealed to be the Echelon Tower in Kinzie Station. Like I said though, there's nothing else really worth covering from Morguard, so we're going to move on to MTY Food Group. And MTY announced an acquisition shortly after I posted last month's video. And after having seen the size of this acquisition, I can now truly appreciate why the management made a note of the $300 million of available liquidity on the conference call last quarter. See, on August 9th, it was announced that MTY would be acquiring BBQ Holdings Group for a monumental $260 million Canadian dollars, which is going to eat up over 85% of MTY's total liquidity. So, naturally, because of the size of this deal, there is definitely going to be an impact in the financial health of the business. But the extent to how much debt or share issuance will be done is as of yet unknown. Higher levels of interest expenses and share issuance could significantly impact shareholder returns, especially with regards to MTY's dividend. Because of this, I think it's worth investigating to come up with a general idea of what can be expected to happen. See, generally speaking, most financially stable, well-performing, dividend-paying companies tend to increase their dividend once every year. If we go back and take a look at MTY's pre-pandemic dividend history, you can see that this is also the case, with consistent increases every 4 quarters, but with one exception in 2017. This was because in mid-2016, MTY acquired Kahala Brands, which was the former owner of several brands including Cold Stone Creamery and Baja Fresh. Now, if the current BBQ Holdings deal can be called huge for the company, then in 2016, the Kahala Brands deal for MTY was super huge. Not only did the Kahala acquisition cost the company $310 million, but it also came at a time when MTY was trading at a market cap of under $700 million, as opposed to the current market cap of over $1 billion. So there is definitely a massive difference in scale between the relative sizes of the Kahala and BBQ Holdings deals. However, even though these two scenarios aren't the same, it is still beneficial to go back and take a look at how the Kahala deal was undertaken. Back then, MTY only had 43.6 million Canadian dollars in cash and equivalents, and the company also had access to around 34 million Canadian dollars through their line of credit. Thankfully, MTY negotiated for a new revolving credit facility and loans that allowed the company access to over 325 million Canadian dollars. Combining this with the cash on hand, there would have been enough money to complete the deal. But despite having access to enough capital, MTY also issued shares. Though this wasn't done specifically to raise capital for the acquisition. Rather, as part of the deal, Kahala's shareholders wanted to be paid out part in cash and part in MTY stock. Taking a look at the BBQ Holdings deal, it appears as though the shareholders would prefer to be paid purely in cash. So this time around, I don't think we'll end up seeing MTY issuing any new shares, especially when considering that MTY already has enough liquidity to buy BBQ Holdings outright. It's also worth noting that as of July 3rd, BBQ Holdings had a chunk of cash on their balance sheet in the amount of $20.6 million, which will go to MTY once the deal is closed, and that will negate some of MTY's acquisition costs. So, based on the reliance of credit to fund the last deal, and MTY's decision not to issue new shares other than those required to satisfy the conditions of the Kahala deal, we can reasonably forecast that MTY will be relying on their cash and credit facilities to pay for the BBQ Holdings deal, and we can assume that there won't likely be any new share issuance. This means that there will almost certainly be higher debt repayments. The question is, will this stop MTY from raising the dividend for Q1 of 2023? Personally, I don't think so. I think that the most likely outcome will probably be a small raise of 1 or 2 cents per share. This is because even a minor dividend raise will signal to many investors, including dividend-centered ETFs, that the company is doing well, which should in turn lead to several benefits for the company and its shareholders, the most obvious being an increase in share price. That said, I don't think it's out of the realm of possibility for MTY to decide not to raise the dividend. That is, of course, what happened after the Kahala deal, but like I said, the company will be in a much stronger financial position after completing the BBQ Holdings buyout than they were in 2017. Those are probably the two most realistic scenarios running through my mind, though I definitely could see a large dividend raise happening since there's probably room to do that. But I just don't know why management wouldn't first decide to pay down the debt to lower their interest payments before committing to a serious dividend hike. Finally, I would be very surprised if there were to be any dividend cuts, just because the company is still going to be in a relatively strong financial position, with the majority of free cash flows being available to start paying off any new debts. So that's my take on the financial impact surrounding the deal. Now let's take a deeper look at the business that MTY is going to be buying. BBQ Holdings is a company that, like MTY, owns, operates, and franchises restaurants. The company owns 9 different brands that include Famous Dave's, Granite City Brewery, Real Urban Barbecue, Village Inn, Baker's Square, Tahoe Joe's, Barrio Queen, Craft Republic Bar and Grill, and Champ's Kitchen and Bar. Unfortunately, I haven't eaten at any of these restaurants before, but I've at least heard of Famous Dave's, which is BBQ Holdings' flagship banner. Taking a look at the income statement, we can see that revenues for the year so far have been roughly $64 million in Q1 and $80 million in Q2. That's a pretty good amount of revenue, but looking at how that revenue converts into net income, combined year-to-date net income was just under $5 million, which is pretty abysmal on total year-to-date revenues of $144 million. And moving over to the cash flow statement, we can see that this translates into free cash flows of roughly $4 million, which isn't really any better. Now, if you focus your attention on the year-over-year differences, you'll notice that last year, despite revenues being lower, net income was significantly higher. To clarify, this wasn't because the business had higher margins in 2021 or anything like that. This came almost entirely because of the line item gain upon debt extinguishment, which, if we go to the annual report, we can see that this was due to COVID-related PPP loan forgiveness. That means that this unfortunately won't be repeated. As far as free cash flows go, it is possible for the company to get back to 2021's level of free cash flows. Unfortunately, this will require better operating cash flow performance on the now higher lease liabilities and lower rates of capital expenditures, and we cannot assume that this will happen. So instead, let's assume that the next 2 quarters of free cash flow will be identical to the first 2 quarters, in order to build a rough estimate of what MTY paid for the business. Doing this would mean that BBQ Holdings would produce $7.85 million in free cash flows over the course of fiscal 2022. Now, MTY paid $200 million for the company, which should be offset by about $20.62 million that BBQ Holdings holds in cash on the balance sheet. Dividing the projected free cash flow by the cash-adjusted cost of the deal would give BBQ Holdings a price to free cash flow of about 22.9. And that's a bit high for my liking, especially considering the low-margin nature of the company. That said, there is a lot more to the story with this acquisition. See, as of July 3rd, BBQ Holdings had 324 total locations, and 116 of these were corporately owned and operated. If we go back to the first quarter, we can see that the company had 315 total restaurants, and 104 of these were corporately owned and operated. This means that even though BBQ Holdings only added 9 restaurants, the total number of corporately owned locations increased by 12. Comparing this to the prior 6 months ended results, we can see that the total percentage of company-owned restaurants increased from 32% to 36%. So, from this, we can assume that BBQ Holdings has been pretty actively trying to increase their company-owned stores. This assumption is further bolstered by the restaurant acquisition section of the company's latest earnings release, under which it documents the purchase of multiple previously franchised locations. This strategy of trying to acquire and operate locations that have already been franchised out is diametrically opposed to MTY's business strategy. In last month's episode, I went over why franchising out successful restaurant brands is generally a better model than trying to operate restaurants yourself. To quickly summarize everything, running a restaurant will bring in more revenue, but doing so is capital intensive because you have to pay for things like food, employees, and kitchen appliances. On the other hand, if you just sell someone the ability to use your brand and you take a percentage off the top of that restaurant's sales, almost all of the money goes to your bottom line, since it doesn't need to be spent on things like restaurant maintenance or large equipment orders. Because MTY's management appreciates the value of this model, the company has been franchising out their corporately owned restaurants. Now, MTY doesn't give out explicit information detailing the going count of corporate and franchise locations, so it is a bit difficult for me to demonstrate this, mainly because MTY relentlessly acquires new companies. And this leads to acquired businesses transferring ownership of their corporate locations to MTY, which in turn boosts MTY's corporate metrics. On top of that, the recent comparisons to pandemic-affected quarters further obscures the numbers. So all I can really do here is point to the recent sale of multiple Papa Murphy's corporately owned locations as proof of this happening. Regardless, we can pretty safely assume that MTY has a much lower percentage of corporate locations than BBQ Holdings' 36%, based on how much their corporate revenue contributes to total revenue. In MTY's case, as of last quarter, corporate revenue only made up about 7.9% of total revenue. As for BBQ Holdings, unlike MTY, they don't directly disclose segmented revenue that distinguishes between corporate and franchise results. And while BBQ Holdings' disclosed metric, net restaurant sales, isn't defined, I think it's safe to assume that it also includes the take from franchise-operated restaurant sales because of the amount that it contributes to total revenues. So, for BBQ Holdings, I'm going to estimate conservatively to be on the safe side, and I'm going to suppose that one of BBQ's corporate locations contributes the same amount to total revenue as one franchised location would. This would mean that only 36% of total revenue would be coming from corporately operated locations, versus MTY's 7.9%. So, what does all this mean? Well, based on how poor BBQ Holdings' free cash flow margins have been, as well as how high their corporately operated locations are relative to MTY, There are likely a lot of underperforming locations that can be franchised out once MTY's management takes the reins. If MTY does this, we will very likely see substantial increases in free cash flow stemming from a decrease in both capital and operating expenditures. On top of that, we know that supply chain issues have been negatively impacting margins in the past few quarters, which may be acting as a temporary headwind to BBQ's profitability. Also, with the new adoption of BBQ Holdings' larger restaurant brands, we will likely see an opportunity for MTY to integrate some of these restaurant recipes into their retail product side of the business. To summarize all of this, the deal is definitely much better than it looks when simply analyzing the raw numbers. But, to be fair, paying a 23 price to free cash flow for a low-margin business doesn't exactly look great to begin with. That said, if franchising out most of the corporately owned restaurants can get BBQ Holdings' net income margin in line with MTY's at around 15%, then I could see this acquisition being incredibly accretive, giving this scenario-adjusted price to free cash flow ratio in the low double-digit to potentially even high single-digit range. Though that is purely speculation on my part, and would require execution of a plan that hasn't even been spoken about by MTY's management. So, as of yet, this deal is still kind of up in the air for me, and while it can be fun to think about different possibilities, I'm going to hold off on any judgment until I first hear more about the management's plans, and second, see some execution, though I do remain cautiously optimistic going forward. On a side note, MTY's total retail product offerings again dropped this month from 174 products down to 159. Like I said last month though, I don't think that this is a huge issue. The company was previously very ambitious with the number of products that they were releasing, and now I think that the company is at a point where they have enough consumer data to have a good idea of which products are underperforming. So, pulling those down and focusing on expanding out the top performing products is definitely a better idea than continuing to spend money pushing out products that may not sell. That's not to say that there can't or shouldn't be any new products, I just think that it's a better idea to be a bit more selective and conservative at this point. So, with that, let's now get into the important information from Knight Therapeutics' second quarter financial results and conference call. And for the most part, this release was pretty standard fare without any big news or revelations. Of course, Knight did make deals with Helsinn and Rigel, but that was announced just subsequent to the first quarter's results, and I already covered that in detail back in month 6's video. And this quarter, we didn't really get any additional news regarding either of these deals in the report or in the conference call. What we did learn was that total revenue increased by 10%, or around $7 million on a constant currency basis, which just corrects for foreign currency exchange rate fluctuations. And this increase in revenues was partially due to the growth of some of the recently launched products, but more importantly, it was due to an increase in revenues from Exelon. And Exelon's revenues increased by a staggering 200% over the previous year's second quarter. But before you get too excited, let me explain why this is happening. See, Knight is currently in the process of gaining regulatory approval from multiple different countries to take over the operations of Exelon. But the Exelon deal has closed, and Knight does own the rights to it. That means that the former owner is still operating the Exelon business in the countries where Knight has yet to be approved by regulators. Because of this temporary situation, the former owner, Novartis, has been transferring the profits made from Exelon to Knight Therapeutics. This means that Knight isn't earning any revenue from Exelon in the countries where they are seeking approval, but Knight is still earning the profits because of the transfer. Now, when Knight gets approved by a country to take over the operations of Exelon, Knight also takes over all operations in that country and begins earning revenue there. In this quarter, Knight was approved to take over the operations in Colombia, which is why the revenue from Exelon has again increased dramatically. So, a lot of this growth has to do with the way that revenue and profit is being accounted for, and is not due to the actual market growth of Exelon. Aside from that meriting its own explanation, I also want to note that the irregular country-specific impacts on Exelon's marked revenue are expected to continue into Q3 and Q4, as Knight takes over commercial activities of Exelon in Brazil, Mexico, and Chile. That said, as of the first quarter of 2023, Knight should have full operational control over Exelon's commercial activities. Also, going forward, because Knight will be accounting for Exelon's earned revenue on top of the profits that are already being accounted for, it is expected that gross margins will negatively be affected until Knight has fully taken over Exelon's commercial activities. For this quarter, however, gross margins were 51% or 54% when adjusting to exclude the impact of hyperinflation. As far as earnings go, the company reported net income of $2.5 million in the quarter, which was 91% lower than last year's. Now, again, before you get too excited, this is mostly due to a net loss on financial assets. In Knight's case, these are made up of shares of publicly traded companies which happen to decline in value by nearly $7.7 million. These equities were not sold during the period, but they still have to be accounted for on the income statement, and thus affected the net income. Comparing against Q2 of 2021, these publicly held shares had gained by nearly $28.5 million, which made up the bulk of Knight's $29 million of net profit in the quarter. So, if we adjust to exclude the change in value of the financial assets, Knight would have adjusted net income of $10.2 million in this quarter versus $532,000 in the second quarter of 2021. Still, net income often doesn't tell the full story, which is why I generally prefer to look at the free cash flow, which shows the cash that's been generated specifically by the business's operations, after subtracting out the cost of operating the business. Doing this shows that Knight's second quarter of last year generated about $670,000 of free cash flow more than in the most recent quarter. But this still doesn't tell the full story. This is because the diluted shares outstanding have come down considerably since last year's Q2 results, which has led to an interesting occurrence. If we take the free cash flow and divide that by the shares outstanding, we get the free cash flow per share. And in this case, Knight's free cash flow per share came out to be 9.98 cents versus 9.66 cents in last year's quarter. So, even though the business saw a slight decline in free cash flow, shareholders saw their ownership increase enough to more than offset these declines. Still, it certainly isn't preferable to see Knight's total free cash flows decline. But I think that it is worthy of note that Knight's free cash flow levels have historically been pretty sporadic, so I definitely wouldn't hold a single quarter's decline against the company. I think that's about all I wanted to get into with regards to free cash flow, so let's take a look at how capital was allocated in the quarter. We already know that the company did repurchase a bunch of shares, and Knight did not announce a dividend. So let's head over to the balance sheet to check on the debt levels. Aside from buying back shares, we can also see that the company clearly paid off a chunk of debt, though total liabilities did rise, mostly due to higher accounts payable and other liabilities. This quarter, the lowering levels of cash and higher level of total liabilities did once again push the tangible book value per share lower. But, like last quarter, that's to be expected when the company is aggressively repurchasing shares, and when there are large amounts of intangibles held on the balance sheet, which did see a bump this quarter due to the recent deals with Rigel and Helsinn. That's about all there was to go over from Knight's results. Now, there was mention from the CEO in the conference call about deal flows looking healthy, so there could be more acquisitions coming soon, but other than that, not much. Overall, I'd say that this was a pretty bland quarter from Knight, though I wouldn't say that that's necessarily a bad thing. And I think that concludes this month's news segment, so we're going to move along into the monthly portfolio's performance. And August was actually a pretty good month, until about the last week or so. Morguard's shares dropped by about 6.3%, not including the dividend. Knight Therapeutics shares also fell by 0.7%, and as of September 3rd, MTY's shares also fell by more than 1.5%, giving back all of the gains that it made announcing the big acquisition. So, in total, the capital invested for the month decreased by 2.71% when factoring in the dividends paid by both Morguard and MTY Food Group. And this left the portfolio value at $766.51, which is back well below both the book cost and the contributed capital. So August was not the greatest month after all. But did the indexes fare better? For the most part, no. All of the indexes performed worse than my portfolio on the capital invested specifically within the month of August, with the exception of the Global Value ETF, which was the only out of the group to gain in value. Surprisingly, the worst performer of August's invested capital was the S&P 500. The reason that I said that this was surprising is because despite the S&P underperforming on this month's capital allocation, for the first time so far, the S&P 500 ETF's total portfolio value surpassed my portfolio's total value and is leading the benchmarks. My portfolio lagged behind the S&P by about 0.5%, and the Global Value ETF was very hot on my heels with less than a 0.1% gap between us. And I want to take a moment to just appreciate the poetic irony in that the very episode after creating a segment talking about how I've been outperforming the market and how the S&P has yet to surpass my portfolio, the S&P managed to pull out ahead on the very last day to unseat my portfolio from the top position. Though, to be fair, the first place position was at some points held by the Global Value ETF within the last few hours before the market closed. So yeah, taking a look at the portfolio's gains net of contribution, you can really see the devastating decline from last month. So, even though the $100 that I invested last month performed reasonably well, the remaining $700 of contribution saw a very steep decline, and the portfolio is now $61.58 shy of the 12% per year goal, which is the largest dollar gap yet. Also, I wanted to point out that I used an incorrect input in my spreadsheet, which did not include the dividends earned in the graph last month. So I went back and fixed that issue, and now the graph shows that month 7 had $4.89 in gains instead of the $3.49 that was displayed previously. And I just wanted to let everybody know for transparency purposes, since I'd hate for people to get the idea that I'm artificially inflating my losses. All jokes aside, as much as I don't like losing out to the benchmarks, I really do love getting quality companies at discounted prices, and I've definitely been buying some shares in my personal account over the past few days, and I'm excited to get the chance to do the same here. But before I go ahead and do that, I'm going to quickly remind everyone once again that the current portfolio performance can still be entirely chalked up to variance. I have only been investing in this portfolio for about 8 months, and there are tons of factors at play that can affect short-term performance either positively like last month or negatively like this month. I can't control how share prices will behave, but I can control how I act when the market offers me prices, and over the long run, making good decisions will lead to good returns. Noting that, it's time for me to now make a decision on this month's $102.07 in contribution and dividends. This month, because all of my positions have dipped and my conviction in these companies hasn't significantly changed at all, I'm going to be once again buying the exact same group of stocks as last time. Unlike last month, however, I'm planning on buying 5 shares of Morguard this time because it has dipped more than the others, and it's still my top conviction. That said, prices may change by the time I get to buying tomorrow, and if that does happen, then my plans may also change. But assuming there aren't any big swings, then I'll probably end up buying 1 share of Knight Therapeutics, and with the remainder of that money, I'll be buying MTY Food Group. So that's my plan going into tomorrow. Now let's hop to the clip of me buying shares. Alright, I'm here in the account. I have $102.07 to spend, so we're going to start off with Morguard. It looks like it's currently trading at $16.50. I'm going to try and buy 5 here. And we're just going to do a market buy. Now we're going to do Knight Therapeutics. How much money do we have left? We have about 20. So I'm only going to buy 1 here. Okay. And now we're going to put the remainder into MTY Food Group. Fractional buy, and we have 13.81. Alright, so I have no funds left to spend, so I'll see you when the MTY order comes through. Okay, I'm back and everything has been filled. I got my 5 shares of Morguard for $16.53 each, and I also received 1 share of Knight Therapeutics for $5.61. And last was the MTY order, which filled for about 0.234 shares at a price point of $59.02 per whole share. This time, as you can see, I've already put everything into the spreadsheet. So taking a look at the portfolio, after market close on Friday, September 2nd, the portfolio holds 37 shares of Morguard worth nearly $610, as well as about 2.57 shares of MTY Food Group worth a touch over $150, and 19 shares of Knight Therapeutics currently worth roughly $106. And this time there was 1 cent left over in the portfolio from the fractional buy, but that's nothing to really be concerned with, since I'll just end up using it next month. Moving on to the dividends, this month I received $1.63 in dividends from Morguard and 44 cents in dividends from MTY Food Group. Combined, I received $2.07 in distributions, which was the portfolio's best month yet. Though this was slightly below the predicted amount, which was solely because of an error on my part. See, I accidentally calculated the dividends from my total MTY share count when I should have only calculated for shares that were held before the ex-dividend date. But either way, that's more of just a fun metric that I use to see how accurate my projections are, so I'm going to let any errors or differences there tally up over time. As for the actual cumulative dividends paid, the portfolio has now received $7.12 in total. So it's nice to see that the dividends are continuing to grow, but next month will be the first time dividends paid out will be less than the previous month. And this, again, isn't too big of a deal. It's just because MTY only pays a dividend once every 3 months, and last month was that month. So the 32 shares of Morguard are expected to be the sole distributors of cash in the portfolio for the month of September, and I expect to receive $1.87 from them in total. If we take a look at the portfolio's current annual yield, I'm now expecting to receive $28.04 in distributions on an annual basis, assuming no changes are made to the portfolio or the amounts that the 3 holdings distribute. This gives the portfolio a yield on contributed capital of 3.12%, which is up 8 basis points from last month, and this is just because of the increase in capital allocated to Morguard shares this month, since they pay out the highest yield. And that was pretty much everything. But before you go off and decide to copy what I've been doing in my portfolio, I encourage you to be aware that this video should not be used as a substitute for doing your own research. Instead, this video should be used as a jumping off point to do your own research into companies that interest you. This video is not financial advice, and it does not have the information required to make good investment decisions on individual securities. This video is made entirely for the purpose of providing inspiration and insight into my personal investment decisions. I am not a financial advisor, I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value in this video. And if I did, please consider sharing it with anyone else who might also benefit from it. Thank you for watching all the way to the end, and enjoy the rest of your day.